The top 1% of Americans own 50% of every stock in this country. But here's the part that never makes the headlines. The stock market is not even where they keep most of their money. Right now, while your financial advisor is telling you to max out your 401k, dollar cost average into index funds, and stay the course, the ultra wealthy are sitting quietly in five completely different asset classes. Assets that are legally shielded from taxes, assets that do not move when the stock market crashes, assets generating 15%, 20%, even 36% annual returns, completely off the public radar. And the reason you have never heard of them is not an accident. It is a feature of the system. I am going to show you all five today, and by the time this video ends, you will understand exactly why the gap between the wealthy and everyone else keeps compounding. And it has almost nothing to do with how hard you work or how disciplined you are with your savings. It has everything to do with access to a financial system that most people do not even know exists. Before we name the assets, you need to understand the structure keeping them invisible. Family offices, the private wealth management firms that serve billionaires and centimillionaires, allocate between 35% and 44% of their entire portfolios to alternative investments. Not stocks, not bonds, not anything your broker has ever put in front of you. Multifamily offices collectively manage over $5.2 trillion in global assets. That's roughly 8% of the entire world's pension pool, and a massive chunk of it is sitting in assets the general public cannot legally access. Why can't you access them? Two reasons, both structural, both deliberate. The first is regulatory. The SEC restricts participation in private investment offerings to accredited investors, individuals with a net worth over $1 million or income over $200,000 annually, and qualified purchasers who need $5 million or more in investable assets. That single rule quietly locks out the vast majority of Americans before the conversation even begins. The second reason is incentive-based. Your financial advisor makes money on commissions tied to high-volume, scalable products, mutual funds, ETFs, annuities. These private alternative assets require bespoke legal structuring, specialized underwriting, and continuous management. There's no easy commission, no scalable product, no incentive to bring it up. So they never do. The result is a public awareness gap that has been quietly compounding for decades. Now let's walk through what's on the other side of it. There are only 3,061 of these policies in existence across the entire United States. It is called Private Placement Life Insurance, PPLI, and while the name sounds like a standard life insurance product, it functions as something completely different. It is a tax-exempt investment wrapper, a legal structure that allows ultra-wealthy families to invest in hedge funds, private credit, and private equity and pay absolutely zero tax on the gains. Here's the mechanism. Under IRS tax code, investment gains made inside a life insurance policy grow completely tax-free. That process is called inside buildup. Wealthy families fund these policies with millions of dollars in premiums. The average policy value at the market's leading provider is $38 million, and then borrow against the accumulated cash value at favorable tax-free rates to fund their lifestyle and investments. When they eventually pass away, the entire accumulated wealth transfers to their heirs as an income tax-free death benefit under IRC Section 101. The strategy has a name on Wall Street. They call it buy, borrow, die. The numbers reveal exactly how powerful this is. A business owner who commits $6 million into one of these policies, compounding at 7% annually, accumulates approximately $38 million at death after 30 years. The exact same portfolio held in a standard taxable account, paying taxes on gains every single year, like the rest of us, accumulates only $22 million. $16 million. Vanished. Not to bad investments or poor decisions, to taxes. The U.S. Senate Finance Committee investigated the structure and confirmed what wealthy families already knew. The average PPLI client carries a net worth well over $100 million and an annual income exceeding $7 million. The minimum premium commitment to establish a policy typically starts at $1 million to $3 million, spread over several years. Family office adoption of PPLI has increased by 45% since 2024. The wealthy are not slowing down. They are accelerating into the structure, specifically because massive intergenerational wealth transfers are approaching, and they intend to move every dollar to the next generation, untouched by estate and income taxes. But here's the part worth sitting with. This $40 billion tax shelter is used by fewer than 3,100 people in a country of 330 million. Not because it is illegal, because the entry requirements ensure almost nobody qualifies. This one is going to genuinely surprise you. Some of the most sophisticated investors on the planet, sovereign wealth funds, university endowments, multifamily offices managing billions, are funding other people's lawsuits, and they're making 15 to 30% annual returns doing it. It's called third-party litigation finance. Here's how it works. A wealthy investor provides non-recourse capital to a plaintiff or law firm to cover the costs of high-stakes civil litigation, antitrust cases, intellectual property disputes, class actions, international arbitrations. In return, the investor receives a contractually negotiated portion of any successful settlement or court judgment. Non-recourse means if the case loses, the investor loses their entire capital. Binary outcome, win everything or lose everything, which is exactly why the funds that do this conduct exhaustive due diligence on case merits, damages, and the ability of the defendant to actually pay. The returns on successful outcomes are extraordinary. A 3x recovery in 2 years produces an annualized return of 73.2%. Even stretched across 7 years, that same outcome delivers 17% annually. Academic research published in the Journal of Alternative Investments confirmed that well-underwritten litigation portfolios delivered historical annualized returns in excess of 20%. But the return isn't even the most interesting part of this asset. A lawsuit's outcome depends on statutory evidence, judicial rulings, and legal arguments. It has absolutely nothing to do with the Federal Reserve, inflation, interest rates, or a stock market crash. In a financial environment where almost every asset class moves together when panic hits, litigation finance operates on a completely independent track, complete structural non-correlation to public markets. The global market for this asset class sits between $17.2 billion and $27.9 billion as of 2025. North America accounts for $7.1 billion of that. The top 200 law firms in the United States now represent 35% of all new commitments. In April 2025 alone, Ares Management acquired a 70% stake in a litigation fund for approximately 320 million Australian dollars. Lawyers and billionaires identified this opportunity years ago. The rest of the investing world is just starting to catch up. Ultra-high net worth individuals hold an estimated $2.17 trillion in fine art and collectibles, and most of them never sell a single piece. Not because they're emotionally attached, because selling triggers a federal capital gains tax of up to 28% on collectibles, plus auction house commissions that routinely exceed 20 to 25% of the sale price. That's a catastrophic combined tax and transaction cost event on a single piece. So instead of selling, they borrow. This is art-secured lending. Here's the structure. The collector uses their artwork as collateral to secure a loan from a specialized lender. The lender files a legal document called a UCC-1 financing statement, which protects their interest, but the collector keeps the painting hanging on their wall. No sale, no taxable event, no auction house, immediate cash to deploy into other investments. Boutique art finance firms charge interest rates between 15 and 25% on these loans, but they protect their capital by capping loan-to-value ratios at 50% of appraised value. Even in 2024, when the global art market fell 12%, the lender's capital cushion remained intact. The outstanding volume of art-secured loans globally currently sits between $33.9 billion and $40 billion. That's up from $29.2 billion just 2 years ago. And 51% of private wealth managers worldwide now offer dedicated art lending services, up from just 25% in 2011. The logic is clean. Your art generates zero cash sitting on the wall, borrow against it at 15%, redeploy that capital into something returning 20%, pocket the spread, pay zero capital gains. That's the arithmetic of wealth preservation in action. Bill Gates is the largest private farmland owner in the United States. Through his private investment arm, Cascade Investment LLC, he has quietly accumulated between 242,000 and 248,000 acres of prime agricultural land across 17 states. A single purchase in eastern Washington cost $171 million. This is not a passion project. It is a calculated allocation. The data behind the decision is compelling. Over the past 3 decades, the NCRIEF Farmland Index delivered annualized returns of 10.15 to 10.4%, comparable to equities, but with a standard deviation of only 6.3% to 6.8%, dramatically lower volatility than the stock market. The result is a sharp ratio of 1.10 to 1.24, exceptional risk-adjusted performance by any measure. Farmland also carries a correlation of negative 0.26 to public equities and negative 0.08 to bonds. When markets crash, farms keep producing food, and food prices rise with inflation, meaning farmland is one of the few assets that actually benefits from the monetary environment most investors fear. The long-term structural case is even more powerful. The United Nations projects global population will expand to 9.7 billion by 2050. Feeding that population will require doubling agricultural output from 2010 levels. Meanwhile, the global supply of arable land is shrinking, not growing. Finite supply, expanding demand. Simple math. Wealthy landowners use Section 31X1 exchanges to roll appreciated commercial real estate or business sale proceeds directly into farmland portfolios, completely deferring capital gains taxes. The land generates reliable 2% to 4% annual cash rental yields from tenant farmers, while it appreciates. And unlike any financial instrument ever created, nobody can manufacture more land. Over 97% of U.S. farmland remains privately held by legacy agricultural dynasties and ultra-wealthy families. Institutional funds currently control only 2 to 3%. The institutional wave has barely begun. No asset class in the United States receives more deliberate legislated tax advantages than direct oil and gas working interests. Here is the structure. When an accredited investor purchases a direct working interest in an oil or gas drilling operation, they become a fractional owner of the operating rights. They bear a proportional share of all drilling costs, and in exchange, they receive a proportional share of all production revenue. The tax treatment is extraordinary and entirely intentional. Under IRC Section 263C, investors can immediately deduct 100% of intangible drilling costs in the year they're incurred. Intangible drilling costs, labor, chemicals, hauling, fuel, site preparation, typically represent 60 to 85% of total well costs. On a $100,000 investment with an 80% IDC allocation, that's an $80,000 tax deduction in year 1 before the well produces a single barrel. For a high-income earner in the top 37% federal bracket, that $80,000 deduction eliminates $29,600 in federal taxes immediately. But here's what makes this structure truly unique compared to real estate. Under IRC Section 467, working interest losses are classified as active losses, not passive losses. That means they directly offset W-2 income, business profits, bonuses, dividends, and interest. No material participation test, no limitations, direct dollar-for-dollar offset against the income streams that carry the highest tax rates. On a successful horizontal shale well, a $100,000 working interest can generate annual distribution returns of up to 80% during peak production. Elite private drilling partnerships target IRRs of 30 to 36%, and the ongoing 15% percentage depletion allowance provides a permanent tax-free shield on production cash flows. The risks are real and significant. Working interest owners face unlimited personal liability for environmental events unless they hold through an LLC. Capital calls are possible, and refusing them triggers severe penalties. The asset locks up capital for the 20-plus year life of the well, and high-income earners need to monitor alternative minimum tax exposure. But for a business owner staring at a $500,000 tax bill in December, this is one of the only legally available structures that Congress deliberately designed to provide immediate and substantial relief. 5 assets, 5 completely separate financial worlds, all operating in plain sight, behind a legal and structural wall that most Americans never get close enough to see. Private placement life insurance eliminates tax drag across generations and transfers wealth to heirs untouched. Litigation finance generates 20+% returns from courtrooms completely correlated to any market cycle. Art-secured lending converts $2 trillion in hanging collectibles into tax-free deployable capital. Farmland delivers equity-level returns with bond-level volatility as the global food supply tightens. And oil and gas working interests turn a massive tax liability into an immediate write-off with serious production upside. The system is not hidden because it is illegal. Every single one of these structures is entirely legal, actively used, widely known among those who qualify. It is hidden because the entry requirements, accredited investor status, qualified purchaser thresholds, million-dollar minimums, ensure that the conversation never starts for most people. Now you know the 5 assets exist, you know how they work, you know the numbers behind them. The next question is the one that actually matters. Which of these structures have lower access points emerging right now? And what does a realistic path in actually look like for someone who is not already worth $100 million? That is exactly what we are breaking down in the next video.